9 simple steps to start investing today. Hi, my name is Neera and welcome to my channel. Investing has become much more accessible to anyone who wants to build a passive income stream with less barriers to entry and less fees. In this video, I wanted to share with you basic steps you need to take to start investing today. Before moving to the 9 steps, let's start with the why. Why should you invest? The core principle in finance is time value of money, which states a sum of money is worth more now than the same sum will be at a future date due to its earning potential. In other words, if you keep all of your money in the savings account or even money market account, you are effectively losing the buying power of your money due to
inflation, I'm afraid.
In comparison, inflation on average is 2% to 2.5%, and the money market accounts are under 1%. Savings accounts are even less. Also, keep in mind, the earlier you start, the better, due to the power of compounding. Let's see an example and compare the results. Let's say you start with $100 and invest $100 each month. In 20 years, at an average annual rate of return of 8%, you will end up with $55,380. Whereas in 30 years, with the same return, you will have $136,946. That's a 147% increase if you just start 10 years earlier. One last tip. Whenever you feel like buying a pair of Nike shoes, for instance, invest in Nike stocks instead. Consider this, for instance, you bought 2 shares of Nike at the beginning of January 2018 for $63.90 each for a total of $127.96, instead of a pair of Nike shoes for approximately the same amount. On January 2022, the shares would have returned 145%, whereas your pair of shoes would have worn out by now and lost value. Now that you're hopefully motivated, here are 9 steps you can take today to start investing. First, and the most important, is know your risk tolerance. In other words, know your ability and willingness to stomach a decline in the value of your asset. This will define what type of financial instruments you want to invest in. Just ask yourself a simple question. If the value of your assets drop 5%, would you sell? If 10%, what about 20%? If you answered yes to 5 and 10%, you're not very comfortable with a high risk. If you answered no to all 3, then you would prefer a more aggressive portfolio. An honest response to these questions will build a portfolio that you'll stick to. Number 2, decide on a brokerage account. There are some to choose from. Personally, I like to go with the more traditional ones like Charles Schwab, which I currently use, Fidelity or E-Trade. You could also use Robinhood, M1 Finance, Webull, and etc. Here are a few things to look out for when you're comparing. Minimums to open or maintain an account, trading fees or any other hidden fees, financial instruments they offer and whether it fits your needs, trading platform, whether it's mobile friendly, if it's important to you. If you just want to invest your money and forget about it and see it play out in the long term, then it shouldn't matter to you. Last but not least, I like to pay attention to the welcome bonus. It shouldn't be the deal breaker, but if there's a tie, this usually helps me to decide. Number 3, define your investing strategy. Take into consideration the first step we discussed on risk tolerance. Are you a short-term trader or a long-term investor? Are you more comfortable with passive investing in ETFs or index funds? A good idea might be a mix of different instruments to balance your portfolio and protect it from a downside risk. We'll cover this a little bit later. Number 4, try out stock market simulators. If you're completely new to investing, I highly recommend using stock market simulators to gain experience and feel comfortable with investing without risking any money. There are free-to-use stock market simulators that you can start using today. Number 5, diversification. The saying goes, don't put all of your eggs in one basket, which was extended to don't put your eggs in too many baskets. Confusing, right? That means you would want to diversify to protect your portfolio from downside risk, but not too much. You could do so by mixing your portfolio with different stocks, bonds, ETFs, and index funds. An additional tip, you would also want to diversify in the industries that you get your sources of income from, like salaries, to avoid overexposure. For example, if you work in real estate, it will be wise not to invest in it too much. If unfavorable market conditions affect negatively on the real estate market, you will lose more if both your income and portfolio are tied to it. Which brings me to my next point. Number 6, invest in what you know. Although you should be cautious about overexposure that we just discussed, you might want to invest in industries that you work in, since you understand the ins and outs of the business. Alternatively, you could invest in brands you and your friends already use and like, but don't overuse this. Number 7, consider robo-advisors. Initially, investing and diversifying your portfolio can seem too complicated, so I would recommend to consider robo-advisors. If you want to let an algorithm make your investment decisions, rebalance your portfolio for you, and lower your fees, then this is an option. I personally haven't tried them yet. If you want me to experiment and create a video review, comment down below. Number 8, read, read, and read. I cannot stress enough how reading is important in investing. Warren Buffett, one of the best investors in the world, has a reputation for an avid reader. You could read about investing from professionals who managed to put decades of experience into one book. It will also help define your investment strategy by knowing the ins and outs of different strategies. And final point is to keep in mind that investing bears some risks. It is always possible that the value of your investment might lose value over time. So invest with caution and manage your risk. Start today and make your money work for you.